If you refinance your mortgage right now, there's a very real chance you're about to give your bank tens of thousands of dollars to quote unquote save money. I just saw someone try to save $9,000 in interest, but get charged $18,000 to do it. That's not a bad deal. That's a loss before the new mortgage even starts. And here's the part that no one really talks about. They didn't make a mistake. They took the lower rate. They did what everyone does, what everyone tells you to do, and it still cost them because the real cost of refinancing is hidden in one number that your lender is counting on you to ignore. Let's go. Right now, refinance applications across Canada are climbing fast because rates dropped from the highs that we hit in late 2024. And every Canadian who renewed in the last 18 months, they're asking the same question. Should I refinance early and break my term? The honest answer is yeah, sure, sometimes the math will eat you alive. So let me walk you through the 4 times refinancing actually makes sense today in Canada. The 3 traps that turn it into a loss, and the move your lender will never bring up unless you ask. Reason number 1 to refinance here: a rate drop big enough to clear out the penalty. This is the obvious one, but it's also where I see most people lose money because the rate drop alone, it doesn't tell you if it's worth it. You have to factor in the IRD penalty. If you're on a fixed rate mortgage with a big bank, that penalty is calculated using this long ass formula, and the big banks, they use their posted rate, not the contract rate that you actually signed your mortgage commitment with. The math, it's fucking brutal. Let me explain to you what I mean. I had a client situation last month, a $625,000 mortgage, 2 years left on a 5-year fixed at 5.49%. The new rate they're being offered is 4.29, a drop of 1.2%. Sounds like a win. But the penalty to break the mortgage was 18 grand. That's total interest savings over the remaining 2 years of around $15,000. The net savings, they're $3,000 in the hole before that new mortgage ever starts. Now let's flip it. The same client, the same rate drop, but 3 years earlier, they had placed the mortgage with a non-bank lender because they worked with me, a mortgage broker, a lender that calculates IRDs using the contract rate, not some make-believe Fugazi posted rate. The total penalty on the same break, $5,500, the same balance, the same drop, net savings of $9,000. The decision, it wasn't about today's refinance. It was about who they signed with 3 years ago. Reason number 2 to refinance: if we have to consolidate some high interest debt into your mortgage. This is one of the probably the strongest cases that I see for refis in Canada right now. A lot of Canadians, they carry credit card debt at 21% or a car loan at 9% or an unsecured line of credit, which I don't know why you would ever have, at 7%. You fold that into your mortgage at 4 to 5%, it can literally save you thousands in interest every single year. But, and there's a big but, you have to keep the discipline because once that debt is gone from the credit cards, if you load them back up like 6 weeks later, you've now turned 12-month consumer debt into 25-year mortgage debt, and you're gonna pay it off 3 times over. Reason number 3, pulling equity for something strategic. In Canada, you can refinance your property up to 80% of your home value. So if your house is worth $1 million and you owe $400,000, you could theoretically refinance it up to $800,000, pulling out $400K in cash. For some homeowners, that's gonna make sense. Whether it's a renovation to add rental income or equity, or a down payment on an investment property for their kids, or a strategic investment using something like the Smith maneuver to make the interest fully tax deductible. For the other homeowners, it's the worst decision that they're ever gonna make. When they pull equity to fund their lifestyle, that's how people end up with a $2 million mortgage and no path to retirement. Reason number 4, dropping the default insurance. If you bought your home 3 to 4 years ago with less than 20% down, you're paying CMHC, Sagen, or Canada Guarantee default insurance. That premium got rolled into your mortgage balance. Once you have 20% or more equity in the home, you can technically refi into an uninsured mortgage and walk away from that premium. The reality check here is that insured rates in Canada are always lower than uninsured rates. sometimes by up to 40 basis points. So just because you can drop the insurance, it doesn't necessarily mean that you should. Run the numbers. If your insured rate plus the premium math still beats a new uninsured rate, stay where you are. If the new uninsured rate wins, well then you refinance. Now let me get into the 3 traps that I see all the time. These are the things that turn a winning refinance into a losing one. Trap number 1, the penalty math. I already saw this with that client I spoke to earlier. If you're on a fixed rate mortgage with a big bank, the Big Six, you can literally lose tens of thousands to the IRD calculation. Let me say that one more time. The rate drop can be huge, but if your lender uses posted rate to calculate the IRD, the penalty alone can erase every single dollar of savings. If you're on a variable rate mortgage, well, it's a different story. The penalty, it's usually 3 months interest. It's simpler, it's much smaller, often a few $1,000s. So variable rate clients have far more flexibility to refinance early. Fixed rate, big bank clients, it almost never makes sense unless the rate drop is so substantial that it's clearly in a win. Trap number 2, the no closing cost refinance. Some lenders will tell you that refinances have no fees. It sounds great, but what they're actually doing is taking the legal, the appraisal, the discharge fee, and adding all of it to the balance of your new mortgage. They never tell you this, but so now you owe more than you started with, and you're paying interest on those fees for the next 25 years. If a lender pitches you a free refinance, ask them where their fees actually went. The answer should make you feel very uncomfortable. Trap number 3, resetting your amortization. This is probably one of the most common ones that I see. Someone with a mortgage that has like 22 years left, they refinance it. The lender quietly resets the AM back out to 30 years. Why? Because it's going to lower the new monthly payment. It looks great on paper. It makes the refinance look so much more attractive to you, but you just added 8 years of debt to your life. The same balance, the same lifestyle, 8 more years before you actually own that property. Let me explain the math on this. $500K mortgage, very simple. 22 years left at your current rate. If you refinance to a lower rate, but accept a 30-year amortization, your new monthly payment, it drops by $400 per month. It feels like a win, but over the life of that mortgage, you're gonna pay an extra $115,000 in interest just because you reset the clock. That's not savings. That's a slow leak that doesn't show up until your kids are grown and out of the house. If you refi, tell the lender to keep your amortization the same or shorter. Don't ever let them reset the clock unless it makes sense, because rate drops compound when you keep the payment steady. The amortization is going to shrink with that payment being steady, and you're going to finish years sooner. Same payment, different outcome. Now, here's the move most lenders will never bring up: the blend and extend. If you're with a major Canadian lender and rates have dropped, you don't always have to technically break your mortgage to capture the new rate. Some lenders will let you blend the new lower rate with your existing rate, and then they extend the term to a 5-year fixed. No penalty, no discharge fees, just a lower blended rate that takes effect immediately. Most banks will never volunteer this option because A, they make more money when you break and pay an IRD penalty. The mortgage advisor makes more money with the transaction, but this exists at most major lenders. Let me explain the math on a real scenario. Let's pick $700,000 as a mortgage, 3 years left of a 5-year term at 5.69. A break and refi into a new 5-year fix at 4.39. The rate is better, but the IRD penalty is 19 grand. Now, if we flip it, the same client, the same lender, but we look at a blend and extend, they take the existing 5.69 with the new 4.39 for the remaining 3 years, plus they add 2 more years at 4.39% to extend back out to that full 5 that I mentioned. Blended rate lands around 4.85%. There's no penalty, there's no discharge fees, a lower payment that starts next month. It's not always the absolute lowest rate, but it's almost always the most efficient move for most clients. Always ask for the blend and extend math before you commit to breaking the mortgage. If you've been thinking about refinancing and you want someone qualified to run the actual numbers for you, comment refinance below or book a call through the link that I have in the notes. I monitor the chat, I monitor the comments, and I'll personally respond to you, and we'll set a time to chat and look at refinancing. It's not a yes or no decision, it's a math problem. And the math has three parts. There's the rate savings, the cost of breaking your mortgage, and the structure of the new mortgage that you're going to walk into and assume. If all three line up, then refinance. If even one of them doesn't, stay where you are or blend and extend. I see a lot of people that they don't lose money refinancing because of the rate. They lose money because they didn't run the math on the penalty, or because they let the lender do the work for them and the lender just quietly reset the amortization. The rate is what gets your attention. The structure is what costs you the money. If you want help running the actual numbers on your refinance and your situation, book a strategy call below. No strings attached, no cost to you. And when you're done with this one, go watch my last video where I break down what's going on with the mortgage rate wars today. I'll see you there.